They smashed it. The margin call that destroyed silver just lost 8% in a single session. Gold crashed $156. But this isn't about precious metals anymore. When the world's safest assets fall together with mechanical precision, you're not watching a market correction. You're watching institutions liquidate desperately, selling what they can, not what they want. Someone just blew up, and the shockwave is about to hit everything else. The question isn't why silver fell. The question is, who's next? Welcome to Financial Announcement, where we decode the economic signals others choose to ignore. If you've been following markets long enough to remember when financial news meant something, when analysis wasn't just noise, then you understand why what we're about to discuss matters. We'd be honored if you'd subscribe, not because we need the numbers, but because the conversations we're having here are becoming increasingly rare in today's financial media landscape. And please, tell us in the comments, where in the world are you watching this from? Because what happened to silver yesterday doesn't respect borders? Now, let's examine what really happened. The trading screens told a story that seasoned analysts had seen before, but never grew comfortable watching. Silver sat at $72.75 per ounce. In the span of a single trading session, it had surrendered $6.50 of value. The percentage loss stood at 8%, a figure that represented more than simple volatility. This was violence in numerical form. Gold, the asset that central banks hoard and nations measure their reserves against, fell $156 to trade at $4,378 per ounce. A 3.5% decline might sound modest compared to silver's plunge, but for gold, such movement indicated something far more serious than a routine market adjustment. When traders see gold and silver fall together, when they watch these assets decline in lockstep with unusual force, they recognize a pattern. This pattern has a name in financial circles. It is called a liquidity crisis. A liquidity crisis does not mean investors suddenly decided precious metals were overvalued. It does not mean new information emerged about supply or demand. It means the financial system began screaming for cash, and institutions responded by selling anything they could convert to dollars quickly. The mechanics of this process reveal why precious metals become casualties during financial stress. Large investment funds hold diverse portfolios. They own stocks, bonds, real estate, private equity stakes, and yes, precious metals. These assets serve different purposes. Some generate income, some provide growth, some offer protection. But when a margin call arrives, when a broker demands billions of dollars in cash by end of day, the fund manager faces a brutal reality. They cannot sell their private equity holdings. Those transactions take months to complete. They cannot easily sell their bonds, especially when bond markets themselves are experiencing stress. The buyers have disappeared and prices are falling. However, they can sell gold. They can sell silver. These markets operate 24 hours per day across global exchanges. Buyers exist in London, New York, Shanghai, and Singapore. The transaction settles quickly. The cash arrives in the account before the deadline. So the fund sells, not because they want to, not because their analysis suggests precious metals are headed lower. They sell because survival demands it. They sell to raise the cash that prevents their entire portfolio from being liquidated by force. This is the principle that governs crisis behavior in financial markets. Institutions sell what they can, not what they want. The most liquid assets bear the brunt of forced selling, regardless of their fundamental value. The evidence for institutional liquidation rather than genuine selling appeared in the magnitude and synchronization of the moves. Retail investors, the individual traders managing their own accounts, do not create $156 drops in gold. They lack the size. A distressed institution forced to dump billions of dollars worth of positions in minutes creates exactly this kind of price action. The blast wave from this institutional failure hits silver harder than gold for a structural reason. Silver's market is smaller. When the same volume of forced selling hits a smaller market, the price impact amplifies. This relationship, known as beta in financial terms, explains why gold fell 3% while silver fell 8%. The forced selling was proportionally similar, but silver's smaller market absorbed the shock with greater price volatility. What made the situation particularly noteworthy was the disconnect between financial reality and physical reality. Samsung still required silver for battery production. Solar panel manufacturers still needed silver paste for their installations. The industrial demand that had driven silver prices higher over previous months had not vanished in 6 hours. But financial liquidity had vanished. And in modern markets, financial liquidity moves prices far more violently than physical demand, at least in the short term. The traders who understood this distinction remained calm. They recognized forced selling when they saw it. They knew the difference between a fund dumping positions to meet a margin call and genuine deterioration in silver's fundamental outlook. The question facing the market was not whether silver retained its industrial value. The question was how deep the liquidity crisis ran and whether more forced selling lay ahead. The phone call that destroyed billions in wealth likely lasted less than 60 seconds. Somewhere in a glass tower, a risk manager dialed a portfolio manager. The conversation was brief and surgical. The numbers were non-negotiable. $5 billion in cash, required by market close. No extensions, no negotiations. This is how empires crumble in modern finance. Not through public announcements or dramatic press conferences, but through a phone call that transforms a thriving fund into a liquidation machine. The fund in question, let's call it Apex Capital for the purpose of understanding, had built what appeared to be a sophisticated portfolio. They held technology stocks purchased with borrowed money. They owned government bonds from multiple nations. They had taken positions in currency markets, betting the euro would strengthen against the dollar. And they held substantial positions in gold and silver as portfolio insurance. The strategy worked beautifully when markets cooperated. Leverage amplified their gains. Their investors received impressive returns. The fund managers collected substantial bonuses. Then a single position exploded. Perhaps it was their currency trade. The euro weakened instead of strengthening. Or perhaps their bond holdings collapsed as interest rates moved unexpectedly. The specific trigger matters less than what happened next. Their broker, the institution that had lent them billions to magnify their bets, suddenly saw risk where they once saw opportunity. The broker's own risk algorithms flagged Apex Capital as dangerously exposed. The margin call went out immediately. Now the portfolio manager at Apex Capital faced an impossible puzzle. He needed $5 billion in cash within hours. He looked at his portfolio and began calculating what he could actually sell in that time frame. The private equity stakes? Impossible. Those investments were locked up for years, requiring extensive negotiations with multiple parties to exit early. The real estate holdings? They might fetch good prices eventually, but eventually meant months, not hours. The corporate bonds? Normally liquid, but today the bond market itself was experiencing stress. Buyers had stepped back. Selling large blocks would mean accepting devastating losses, and even then, settlement would take days. But precious metals? The gold and silver positions could be liquidated immediately. They traded continuously. Market makers stood ready to buy, even in size. The positions could be closed, and cash could be in the account within the hour. The portfolio manager made the only choice available. He instructed his traders to sell the entire precious metals position. Sell at market. Sell immediately. Price was secondary to speed. What happened next illustrates why modern markets move with such devastating speed. Apex Capital's sell orders hit the market simultaneously across multiple exchanges. Computer algorithms detected the large selling volume and responded instantly. High-frequency trading systems, programmed to identify institutional distress, began front-running the orders, selling ahead of Apex to profit from the anticipated price decline. Other funds, monitoring the same price action, saw gold and silver plunging and assumed negative news had emerged. Their own algorithms triggered automatic selling. What began as one fund's margin call transformed into a cascade of automated selling, with each wave pushing prices lower and triggering the next wave. This cascade effect explains why the drop appeared so violent and coordinated. It was not a conspiracy. It was the natural behavior of interconnected systems responding to stress with programmed reflexes. The tragedy, from a market efficiency perspective, was that none of this selling reflected changed fundamentals. The industrial applications for silver remained robust. The monetary uncertainty that had driven investors to gold had not resolved. But none of that mattered in the moment. Silver's smaller market size made it particularly vulnerable to this dynamic. Gold has deep liquidity even during stress. Massive institutional orders can be absorbed with moderate price impact. Silver lacks that depth. When billions of dollars in selling pressure hits a market measured in tens of billions rather than hundreds of billions, the price impact magnifies dramatically. This explains the beta relationship. Gold fell 3%. Silver fell 8%. The same forced selling pressure, applied to markets of different sizes, produced proportionally different price impacts. By the time market close arrived, Apex Capital had raised its $5 billion. The margin call was satisfied. The fund survived, though severely damaged. But the collateral damage spread across the entire precious metals market, hitting investors who had no connection to Apex Capital's leveraged bets. This is the hidden cost of leverage in modern markets. One fund's crisis becomes everyone's problem. The irony would be almost humorous if it were not so devastating to portfolios across the globe. Investors fled toward the very instrument that created the crisis. They abandoned tangible assets with thousands of years of monetary history to embrace paper currency backed by nothing more than government promises and printing presses. The US dollar, the fiat currency at the center of every modern financial bubble, suddenly became the safe haven everyone desperately wanted. This paradox defines liquidity crises in the modern era. Logic suggests investors should flee toward real assets during financial stress. History teaches that gold and silver preserve wealth when paper currencies fail. Yet, in the immediate chaos of a margin call cascade, the opposite occurs. The dollar surges. Precious metals collapse. The dollar index, known by its ticker symbol DXY, measures the dollar's strength against a basket of foreign currencies. During normal market conditions, this index moves gradually, reflecting economic fundamentals like trade balances and interest rate differentials. During a liquidity crisis, the DXY transforms into a wrecking ball. What drives this counterintuitive movement lies in the architecture of global finance. The US dollar serves as the reserve currency for international trade and debt. Oil transactions settle in dollars, international bonds are denominated in dollars. Banks hold dollar reserves to facilitate global commerce. This structural role creates artificial demand during stress. When panic spreads through financial institutions, their first instinct is not strategic thinking about long-term value. Their first instinct is survival, and survival means accessing the currency that settles debts, meets margin calls, and satisfies regulators. That currency is the dollar. Banks that were lending freely days earlier suddenly stop. Credit markets freeze. Foreign institutions that had borrowed dollars to fund operations in their home currencies find themselves trapped. They need to repay dollar-denominated loans, which means they must sell their local currencies and buy dollars. This selling pressure weakens foreign currencies and strengthens the dollar simultaneously. The mechanics create a feedback loop. As the dollar strengthens, any asset priced in dollars becomes more expensive in local currency terms. International buyers withdraw from markets. Commodities, which trade in dollar terms globally, face reduced demand. Silver, priced in dollars per ounce, becomes mathematically more expensive for holders of euros, yen, or yuan, even if the dollar price stays flat. But the dollar price does not stay flat. It falls because the strengthening dollar makes every commodity look more expensive and less attractive. The mathematical relationship is simple but brutal. When the DXY rises 10%, a commodity must fall roughly 10% in dollar terms just to maintain the same price in other currencies. This dynamic creates what economists call a deflationary shock. Prices across entire asset classes decline simultaneously. Stocks fall, cryptocurrencies plunge, oil drops, industrial metals weaken. Even real estate begins showing cracks. The only thing rising is the purchasing power of cash, specifically dollar cash. For the business community, this environment poses unique dangers. Companies holding inventory see the value of that inventory decline. Firms with commodity exposure face margin compression. Organizations that borrowed to finance expansion suddenly find their debt burden growing heavier in real terms, as deflation increases the actual cost of repayment. The historical record provides context for understanding what comes next. In 2008, during the depths of the financial crisis, the dollar surged. Gold initially fell as institutions liquidated positions to raise cash. The forced selling pushed gold below $800 per ounce. Analysts declared the gold bull market dead. Then the Federal Reserve responded. Massive monetary expansion followed. Interest rates dropped to zero. Quantitative easing flooded the system with liquidity. The dollar's surge reversed. Gold began a climb that eventually carried it above $1,900 per ounce. The forced sellers of 2008 missed one of history's great monetary metal rallies. 2020 repeated the pattern with even greater speed. COVID panic triggered violent liquidation. Gold fell from $1,600 to $1,500 in days. Silver collapsed below $12. Margin calls forced institutions to dump precious metals alongside everything else. The deflation lasted weeks, not months. Then came the policy response. Trillions in fiscal stimulus. Unlimited Federal Reserve intervention. The dollar's safe haven bid evaporated. Gold reached new all-time highs above $2,000. Silver surged past $28. The forced sellers again capitulated at exactly the wrong moment. The current crash follows the same script in its opening acts. Forced selling creates the appearance of fundamental weakness. The dollar surges as the supposed safe haven. Deflation grips asset prices across the board. But the script's later acts remain unwritten. The policy response will determine whether this deflationary shock proves temporary or extended. The question facing investors is not whether silver has industrial value. The question is how long the liquidity crisis persists before authorities intervene with the inevitable monetary expansion. The silence after market crash carries more information than the chaos during the fall. In the hours following silver's 8% collapse, a different kind of activity began. Not the panicked selling of margin calls, but the calculated analysis of those who understand that crisis creates asymmetry. While retail traders checked their accounts in disbelief and algorithmic systems recalibrated risk parameters, a quieter group began asking different questions. These questions did not focus on why the price fell. That mechanism was clear enough. Forced liquidation, margin cascades, dollar strength. The mechanics were textbook. The questions that mattered looked forward, not backward. What does this crash reveal about system fragility? Where does strategic capital position itself now? And most critically, how does one distinguish between a buying opportunity and a falling knife? History offers a framework, though not a guarantee. The pattern that emerged in 2008 and repeated in 2020 suggests forced selling in precious metals creates temporary dislocations. When institutions dump gold and silver to meet margin calls, they are not making fundamental judgments about monetary metals. They are making survival decisions about liquidity. But the recovery timeline matters enormously for strategic positioning. In 2008, gold bottomed in October and November, then began a climb that lasted 3 years. However, those who bought the initial panic in September before the final capitulation endured months of additional losses first. Timing the exact bottom proved impossible, even for sophisticated investors. 2020 compressed the timeline. The crash occurred in March. The recovery began in April. The entire dislocation lasted weeks. Yet even in that compressed time frame, those who bought too early in the panic experienced painful drawdowns before eventual vindication. The current situation presents unique characteristics that separate it from previous crises. Silver had reached $79 before this crash, a price level not seen in over 4 decades. Gold had climbed above $4,400. These elevated starting points mean the percentage recovery required to reach new highs is smaller, but they also mean more speculative capital had entered the market at higher levels. Speculative capital behaves differently than strategic capital. Speculators trade on momentum and leverage. When prices fall, their stops trigger automatically. Their margin requirements force liquidation. They exit positions not by choice, but by necessity. This exodus, when it occurs from elevated price levels, can be more severe than crashes from lower bases. Strategic capital operates with different parameters. Corporations that need silver for industrial production view price crashes as procurement opportunities. Technology companies requiring silver for electronics manufacturing can secure supply at lower cost. Solar panel manufacturers can reduce input costs. For these entities, the forced selling by financial institutions represents a transfer of wealth from leveraged speculators to patient industrial buyers. The business community faces a more complex calculation than simple investors. Treasury managers at corporations must balance multiple concerns. Holding too much cash during a deflationary shock feels prudent, but if that deflation proves temporary and gives way to renewed monetary expansion, cash loses purchasing power rapidly. Deploying capital too early into falling markets preserves less capital for future opportunities. The strategic framework that emerges from this analysis requires understanding 3 distinct phases. The first phase is the crash itself, driven by forced selling and margin calls. This phase is already underway. It is characterized by high volatility, wide bid-ask spreads, and emotional decision-making by retail participants. The second phase is stabilization, where forced sellers have completed their liquidation and prices find a temporary floor. This phase can last days or months depending on how deep the leverage in the system runs. During stabilization, prices may trade sideways with decreasing volatility. The panic subsides, but conviction has not yet returned. The third phase is recovery, where new buyers emerge and fundamental factors reassert themselves. Industrial demand, monetary uncertainty, and strategic accumulation begin driving prices again rather than forced liquidation. This phase separates patient capital from panicked capital. The challenge for investors and business leaders is identifying which phase the market currently occupies. The crash phase is obvious in hindsight, but difficult to call complete while experiencing it. Every bounce looks like potential stabilization. Every renewed decline feels like confirmation that lower lows lie ahead. What separates successful crisis navigation from wealth? Destruction is the discipline to wait for evidence rather than act on hope. Evidence of stabilization includes declining volatility, narrowing spreads, and most importantly, the absence of new forced selling. When large blocks stop hitting the market, when the algorithms stop front-running institutional orders, when bid sizes return to normal levels, the crash phase is ending. The current crash revealed something beyond the immediate price action. It exposed how much leverage had entered the precious metals market at elevated levels. It demonstrated that even gold, supposedly the ultimate safe haven, becomes a forced sale when institutions face survival scenarios. And it showed that the dollar, despite its long-term fundamental weaknesses, retains short-term power as the global liquidity instrument. For the business community, these lessons carry practical implications. Companies cannot assume precious metals provide stable value during all market conditions. The liquidity crisis demonstrated that financial stress can override fundamental value for extended periods. Strategic hedging must account for this volatility. Yet the crash also reinforced why precious metals maintain their relevance. The very fact that institutions hold gold and silver as their most liquid assets, the positions they turn to when desperate for cash, confirms these assets retain universal acceptance. If precious metals were not valuable, they would not serve as emergency liquidity for global institutions. The question is not whether to position in precious metals. The question is when and at what scale.